What is up, team? Welcome back to Blomonomics. This is a channel where we talk about both short-term swing trading and injecting those profits into long-term assets and growth investing. So today we're going to switch direction a little bit. For the last month, we focused on swing trading and pulling profits, and we will cover at the very end a couple of the swing trades that we've been in, how they're performing, and then what we're planning on doing with those profits. You might be in some of these trades with me, but for the beginning of this video, I really want to touch on these two major extremes that a lot of news sources, other YouTubers, podcasts are all talking about, and that's really the massive melt up that is being driven by money printing, liquidity, rate cuts that are coming, or this major meltdown that could occur. I've heard things about a 25% pullback. I've heard speculation from other folks about an 80 to 90% depression-like pullback in the market. So I personally don't think it is responsible to be dogmatic and say only one of these two outcomes will happen. The truth is both outcomes are on the table, and both are completely logical. That's what makes this market so tricky. So in today's video, I want to break down in a clear, simple Blomonomics format what the melt up scenario could look like, what the meltdown scenario could look like, but really the macro risks behind both and how we build a portfolio so that we win in either event. We don't have to have a crystal ball and predict the future. We're going to set ourselves up to win in either event, but that will mean some adjustment of our portfolios. So let's start with the melt up. Really, the scenario where risk assets are going to continue to rise. So when we think about assets like AI, just tech, crypto, gold, all these like SMR stocks or quantum stocks that you've been hearing about, what is going to cause them to continue rallying higher here? And the market in general. So number one is that the Fed has basically already started easing. So we're expecting rate cuts. The next meeting's on December 10th. So 2 days from now, Wednesday morning. I guess this video will come out tomorrow. So tomorrow, Wednesday morning on December 10th, Jerome Powell is expected to lower rates by 25 basis points. QT is over, so that's already huge. Quantitative tightening's over. Liquidity injections are already hitting the market. So we had $13.5 billion being pumped into the banking system just recently. So this environment is not hawkish. It's really kind of like pre-QE energy. The Dovish Fed chair is likely to come in 2026 here. So Trump has already mentioned that he has his nominee picked, whether that's Hassett or one of the other candidates. It's almost most certainly going to be someone who's more dovish than Powell. What that means, what a more dovish chair means, is rate cuts, QE, liquidity, asset prices going up, and so on. You also have political incentives that kind of favor money printing. So no politician wants a recession heading into an election cycle. So the government needs the market up. They need growth. They need liquidity. And then there's this sort of like tech boom right now that is happening. I know we look at the 1999 internet bubble here that popped. And a lot of the money, the dot-com bubble, that was just being pumped into companies that were not showing any positive earnings at all. The difference of today is you have Nvidia, which, the chart looks similar here. It is up and to the right very hard. But that is also justified because even if you watch their last earnings call here a few weeks ago, they are growing at an astounding rate, both revenue-wise, profit-wise, efficiency, their like free cash flow and so on. It is actually insane. And so we're in an environment where the melt up could continue because these companies are not yet technically overvalued. Yes, they have high PEs or high PB ratios, but at the same time, they're also proving and showing massive growth. So that's the one end. We have the melt up, and we're kind of in the perfect environment right now to experience a melt up. And that's very logical to think that way. The second scenario that could happen is a meltdown. So why we could drop 25%, 40%, 80% in the markets, who knows? I'm not here to speculate, but there are major risks out there that could cause some of these events. So let's get into them. Japanese interest rates are rising. This is the carry trade unwinding if you watch my last video. One of the biggest hidden risks globally right now. So for decades, money flowed out of Japan because borrowing the yen was basically free. Interest rates were so low. That money got invested into US stocks, US bonds, emerging markets, essentially everything. The Bank of Japan is now raising rates. So the yen is strengthening. Margins are getting called. Forced selling of U.S. assets are happening to bring that money back into Japan. Volatility is spiking. Liquidity is essentially drying up and disappearing that was once available through the yen. So that alone is something so big it could trigger one of these big pullbacks or a 25% correction. Commercial real estate is still a massive mess. So offices are still half empty ever since the pandemic. Billions in loans need to be refinanced. We have regional banks, which are, very heavily exposed to these loans. And so that is a major risk. We have the sovereign debt crisis. So the US being, 38 trillion in debt, but, debt levels globally are actually insane right now. US, Japan, Italy, the UK, they're all kind of running to the limits. So that could kind of break the bond market, and the bond market breaking would break the rest of the market. You have China's slowdown. So the China's real estate crisis is not going away. Local governments are very financially stretched, and there's a lot of pain in the Chinese markets right now. You have consumer cracks in the US. So credit card delinquencies are rising. Auto loans are defaulting. Student loans have resumed. You have savings that are kind of being depleted and squeezed out of the middle class. So a weaker consumer equals earnings missed, which equals, multiples falling out of some of these stocks. There's geopolitical risks, so Taiwan, the Middle East, Russia, and there's sort of that AI valuation reset. So if we do think NVIDIA has just had its massive bull run, and we do start to think that some of these AI stocks, they've been overvalued or overinvested in the last year or so, yeah, we could see that also trigger a bit of a pullback because the market is sort of following the direction of the AI stocks right now. So in summary, there's a lot of real reasons why we could have a melt up. There's a lot of very logical, real reasons why we could have a meltdown. The question is, what do we do? We're going to position for both. This is my Blomonomics philosophy here. I'm not trying to predict which extreme is going to happen and or which extreme is going to happen first. We build a portfolio that no matter what wins. And here's the framework and what we're going to be talking about in my future videos here. I'm going to try to post bi-weekly so we have at least 2 updates a week. But a portion of our portfolio is going to be invested into defensive hedges. So gold, silver, cash, short-term bonds, essential commodities, and so on, to protect that value of the money, that if the market does drop, we have dry powder on the sidelines to inject back into the market, find the right picks, and really start to look at that generational wealth building. On the other side, we have high conviction, sort of long-term growth exposure that we need to be involved in. If the market does melt up, we need to be in that market. That is, taking part of some of these AI companies, uranium, quantum, SMRs, as well as just undervalued stocks right now that we see in the market, or undervalued ETFs and sectors that we can be investing in to make sure that if there is a melt up, that we are also getting our piece of that. Lastly, asymmetric upside. And this is what we talk about in Blomonomics a lot, which is the swing trading, taking 10 or 15% of our portfolio, depending on your risk tolerance and how close you are to retirement, investing in some very data-driven, as low risk as possible, as much data and research we can do as possible to take some, what you would presume is high risk trades, and pull those profits, stack those profits, as long as we have a winning percentage, and then drive those into our long-term investments. So we talk about defense, we talk about offense, we talk about asymmetric trading. So over the next few weeks, if this at all seems like content that that you'd like to subscribe to, please subscribe. We're a growing channel here, growing community. You'll never pay for any of my content ever. The whole purpose is that I can just show you what I'm seeing in the markets. I've been actively trading for 13 years. I've been daily trading for the last 6 years, and just to show you how I'm positioning my portfolio and really starting to think about, as a millennial, how I can position myself to actually get this generational wealth. Everyone's talking about, oh yeah, there's going to be major opportunity for generational wealth. No one's actually talking about the playbook to get there, and that is what this channel is all about, that playbook. We're also going to touch on some swing trades. So we've been talking about this trade for the last month here. We jumped into it. It's Duolingo. We bought in at 177. We bought 148 shares. We dollar cost averaged in. I believe I actually bought some more at 174 because I had some more, dry powder on the sidelines. We put about 25K into this trade. We're already up 4,500, which is a 17.14% growth. And then this is our initial investment was about 26 or 36,000 Canadian. And then, our exit price is 250. So our profit would be 10,000 or US or 14,000 Canadian. Taking a really quick look at this trade, I'll actually post the link to the trade in the description so you can go back and watch that video. We go through all the financials of Duolingo. We talk about our entry point, our exit point, why we believe it's going to go up, all the data to back this trade. But essentially, we bought in this little blue circle right here at about 177, and our exit point is 250 up here. I don't want to speculate too much and time the market. This could happen in the next month or two, but I'm presuming this will happen by the spring. If this doesn't happen by, say, March or April, then yes, we'll readjust our portfolio. So, in summary, our melt up or melt down investment allocation and portfolio, how we're building that, the stocks I'm picking, the ETFs I'm picking, what I'm picking to protect my money and investment, kind of going into the current market conditions, as well as we're going to be touching on some swing trades here over the next month. So stay tuned. My next big thing is I bought over 100 shares here of Duolingo so that I could sell covered calls. We haven't yet done much options trading on the channel yet, but I wanted to show you some options trading here. I didn't want to trade before the Fed announcement, which is on Wednesday, tomorrow, December 10th. But after the event tomorrow, we should have some visibility of at least a tonality of how the Fed is talking about the current markets, which will give us a lot more data and line of sight into how we're going to invest into the rest of December and January, February, March. But if there is an opportunity, we will start selling some covered calls, and I'll teach you all about that sort of options trading and how you can make income off your money while you're also just holding your long-term investment. So appreciate you all. Like, subscribe, and we'll talk soon. Thanks so much, team.